If you're wondering when interest rates will come down in Dallas, you're not alone. There are probably thousands of people in Dallas right now waiting for the same thing. You know, their current mortgage rate might be like a beautiful 3%, but when it comes to a home, they really need one, you know, that's either bigger or smaller or maybe even just newer. Either way, the vigil for lower interest rates continues, and fortunately today, we have answers. Well, hello, this is Wendy Pennell, and when we talk about interest rates, the first thing we need to clarify is which interest rate, okay? Are you talking about the Federal Reserve and their targeted rate, or are we talking about like mortgage interest rates? Well, chances are, okay, if you're tuning into this video, it's probably mortgage rates you're thinking about, right? So perhaps the very first thing you need to know, okay, is that mortgage rates are not the same thing as the Fed's rates, okay? They're completely independent of the Federal Reserve, but at the same time, okay, they're influenced, right, by what the Fed does. When the Fed raises rates, right, the entire economy is influenced, and of course that includes mortgage rate. But as Holden Lewis explains, mortgage rates are influenced by many elements, including the inflation rate, the pace of job creation, and whether the economy is growing or shrinking. You know, and of course, you know, he continues, the Federal Reserve's monetary policy is a factor too. So if we want to know the real decision makers on when mortgage rates will come down, we need to talk about the bond market, we need to talk about inflation and job creation, and yeah, we need to talk about the Federal Reserve. And I'll tell you this, whether or not interest rates will come down and when, okay, it's really not that much of a mystery. So what is the bond market telling us right now about mortgage rates? Well, let's talk about that first, right? As Jeff Ostrowski explains, mortgage rates typically move in lockstep with the 10-year Treasury. Okay, the average rate on a 30-year loan, okay, is usually going to be 1.5 to 2 percentage points above the 10-year rate. Now, if right now, right, we were in an ordinary static market, okay, we would see bond rates and mortgages like 1.5 to 2 points apart, okay? If we saw that, we would know, you know, things are sailing along normally. There's no real change on the horizon. So is that what we're seeing? Well, no, okay? Rather than that typical 2-point spread, Ostrowski explains that the gap has widened to more than 2.5 percentage points. Joel Can, vice president of the Mortgage Bankers Association, explains that the spread between mortgage rates and the 10-year Treasury has been abnormally wide since early 2022. He continues explaining further narrowing of that spread is expected to put downward pressure on mortgage rates in the coming months. Is he right? Well, today's bond rate is 3.386%. Okay, so historically, right, if a bond rate was like, you know, that 3.3%, right, mortgage rates would be no higher than 5.3%. So what are today's rates? Well, right around like 6.5%. So what does Can mean when he says the spread will put downward pressure on mortgage rates? Well, usually when mortgage rates go up, bond rates will go up in order to be competitive. That's what keeps the two in lockstep, right? Well, mortgage rates are higher risk than bonds, so they typically have to offer a higher amount in order to be competitive to investors. The higher the interest rate goes on a good, solid performing mortgage, the more investors are going to be like, well, no, I'll go with that. I don't want the bonds, right? And in that scenario, the bonds would have to raise their rates closer to the mortgage rate. Well, in this case, these mortgages at 6.5%, they don't really have value, okay? That investors just, they aren't really interested, okay? So why would that be, right? Why aren't they interested? Because no one believes mortgage rates will stay high. Now, why should that matter? Well, if mortgage rates, you know, are gonna come down like imminently, who wants a 6.5% mortgage as an investment that's just going to be refinanced? Because by the time, you know, that investor goes in and pays, you know, like the transaction fees to invest, by the time they do that, it's already going to be paid off, right? Because it's going to be refinanced. So there's no return on that investment. So the bond market can offer lower and lower rates because no one sees value in the mortgages. Okay, so people right there, that screams that interest rates are coming down. So like clue number one, you know, to knowing when rates are coming down is the bond market, right? Watch the spread between mortgage rates and the 10-year Treasury. The wider that spread, the more you can expect interest rates to drop. So as of today, the spread is 3.3 to 6.5. Okay, so that's a spread of 3.2. And remember, you know, normal market interest rates staying the same, not changing, okay, we would see a spread of like 1.5 to 2 points. So the wider that spread, the more confidence you can have that the rates are coming down and that they're probably going to come down pretty soon. Okay, but soon, I get it, I hear you, that's not really quantitative. So now let's talk about the Fed and see if we can pin this thing down a little more. All right, well, we know the Fed has two jobs, right? To encourage job growth and keep inflation down. And we know their main tool they have to do that is interest rate movement. But how much do they actually influence mortgage rates? Well, as Holden Lewis explains, the Fed and the mortgage market move like dance partners, okay? Sometimes the Fed leads, sometimes the mortgage market leads, and sometimes they dance on their own. Yeah, I kind of like that analogy, okay? You know, dance partners, it's kind of nice. Lewis explains that the Federal Reserve doesn't set mortgage rates, but its actions indirectly affect mortgage rates, okay? He gives a great example of this. He says, the Fed has raised a benchmark interest rate by a total of 5 percentage points since 2022. Mortgage rates have risen less, going from around 3.2% in January of 2022 to 6.6% in May of 2023. So the Fed and mortgage rates, right, they've definitely not moved in lockstep. But Lewis even goes a little step further. He says occasionally the Fed and mortgage rates even move in opposite directions. He goes on to explain that that's how it happened in March, right? In the week after the Fed raised the rates, the mortgages, those rates actually went down. So even though the two don't move in lockstep, okay, we do know that rates coming down is going to be greatly influenced by the Fed lowering their rate. So, okay, let's go there. What will influence the Fed's decision on rate movement, okay? What's gonna cause the Fed to lower their rates? Well, as we mentioned earlier, and Holden Lewis also alludes to, okay, the Fed's mandate is to guide the economy with the twin goals of encouraging job growth while keeping inflation under control. So, you know, as you can imagine, okay, it stands to reason that the Fed is influenced by, number one, unemployment, and number two, inflation. When it comes to unemployment, there's been a lot of talk about both it and job creation, okay? There have been some fantastically huge numbers, you know, of new jobs released by the Bureau of Labor Statistics, only to be like sharply revised a month later, you know, saying, oops, sorry about that, we got the numbers wrong. Even recently, okay, the numbers for job creation were much higher than expected. And then like immediately after they're released, you have these very credible sources claiming that those numbers are completely inaccurate. Still, as Preston Caldwell explains, complicating the Fed's decision on future rate hikes is that the economy is still adding jobs. Jeff Cox comments on this as well. He says the labor market also has remained resilient. ADP reported that hiring by private sector companies increased by 296,000 in April, well ahead of economists' expectations. You know, the Fed has commented many times that the job market has just not cooled off the way that they want, and really even the way they expected it to. So with employment and job creation, you have the numbers being reported as elevated, you know, but those same numbers are like hotly contested, right? A lot of people saying they're not accurate, but really either way, okay, the Fed is interpreting those numbers as a sign that the job market is still hot, and that's not really a good indicator for them dropping rates. Now let's get into inflation rates, because I think this is where we're really going to see our clearest indicators, okay, and the ones you can kind of like nail to the wall, so to speak. Now, how many times have we heard Jerome Powell say he wants inflation at 2%? I mean, pretty much constantly, right? I think we're all very familiar with that 2% mandate. Well, Preston Caldwell comments on this. He says, okay, the Fed will pivot to monetary easing as inflation falls back to its 2% target. And really what he means by monetary easing is that the Fed will begin lowering interest rates. So we know we're looking, right, for that magical 2%. And yet month after month, the news reports that inflation this month, you know, it's at so-and-so, and it's decreasing, but it still falls short of the 2% benchmark. Well, I had to be honest, okay, I'm a little tired of hearing that, okay, because it is so misleading. So let's talk about this, all right? What does the Fed use to measure inflation? Okay, they use two metrics, CPI and PCE. Now, when it comes to CPI, what you need to know is it is a sum of 12 months. So every new month, you drop off the same month last year. Like in March of 2022, for example, you had a monthly measurement of 1.0. Okay, March of 2023 replaced that number with a And everyone celebrates that inflation is coming down, but it's not quite there yet. Well, of course not, okay? We're not gonna make it in 1 month unless we have like this massive negative number. Okay, well, as of right now, we're in May, and April's numbers were just released, right? Okay, April's 2022 measurement of 0.4 was replaced by April of 2023's measurement also of 0.4. Okay, so that really was not just a huge help. But I want you to look at May and June's readings from last year. Okay, May was 0.9 and June was 1.2. So just those two numbers together equal the 2.1 that the Fed's wanting to see for like a whole year. Okay, but here's what I want you to see. Those two numbers are about to drop off. Okay, all this time we've been carrying the dead weight of those two numbers, and they're about to drop out of the equation, right? So by mid-July, when June's readings come out, okay, June of 2023 is going to replace that monster from June of 2022. And it's going to seem like overnight we've had this big drop, right? Suddenly everyone's going to be like, oh, inflation dropped, by this massive number. But you and I, okay, we know differently, all right? We know that this was not some sudden miraculous shift. I mean, it's pretty straightforward and obvious. There's really no mystery to it. Now, for argument's sake, let's just say May and June of 2023 are also 0.4, okay? Same as April. Our inflation rate would be 3.6. So we're suddenly going to be like much lower, but we're still not going to be at the Fed's targeted rate, okay? And then as time passes, continuing on, dropping off both July and August and replacing it with the 2023 numbers, that's not going to help much because both of those months in 2022 were low. So ultimately, at the end of the day, okay, I really don't think the Fed's going to lower rates this summer. I could be wrong, okay? But we won't see the effects of that big number in June drop off until mid-July. And then July's number from last year was 0. So if July 2023 is anything more than 0, they're all going to say that's a setback, all right? So, okay, our rate's going to drop in the summer. Well, if Preston Caldwell is right, you won't need a crystal ball to know that, right? Just keep doing the math month after month, okay? I don't think it's going to. But if we see a huge enough negative number, it could. All right. You might be wondering right now, what about the bank failures, Wendy, right? Well, according to Preston Caldwell, he says, we've argued that recent events are not a game changer for monetary policy. The Fed is going to use liquidity injections to keep distress under control. But is he right? I mean, if we see a massive string of bank failures, is that gonna hasten rate cuts along? I mean, let's be real, okay, how much liquidity injections does the Fed really have? Well, if you listen to the Fed, this is what Jerome Powell had to say about rates, okay? He said, we on the committee have a view that inflation is going to come down not so quickly. He continues, in that world, it would not be appropriate to cut rates, and we won't cut rates. Now, Preston Caldwell says once the Fed wins the war against inflation, it will shift to cutting interest rates in order to get the economy moving again. He continues, we expect the Fed to pause its rate hikes by summer of 2023, then starting around the end of 2023, we expect the Fed to begin cutting the federal funds rate. Now, how about some other experts, okay? How about the National Association of Realtors? Well, Lawrence Yun says rates will stay around the low 6% range during the spring months, okay? Dipping more drastically in the second half of the year as the economy weekend. All right, how about the Mortgage Bankers Association? Well, the Mortgage Bankers Association predicts rates to hover around 6.1% before dipping below 6% in late summer and fall. Okay, ultimately, they expect rates to fall an entire point to 5.3% by year end. When asked why they were saying rates would drop basically earlier, than what anyone else is saying, okay, their response was that they think we're headed into a recession. Now, if a recession hits, right, and any one of our 12 numbers on our graph goes hugely negative, yeah, that could bring us to 2% a lot faster. So the MBA could potentially be right, okay? If we get absolutely hammered by a recession, okay, but those numbers would have to be seriously negative, okay? And we just saw April come in with, a 0.4. Now, in all of this, okay, one thing you need to pay attention to, okay, and I hope that you're seeing, is that every single expert says rates will be coming down within 2023. Okay, there's not a single source that says rates will stay and continue on into 2024 like this, all right? So my prediction, personally, I think we're talking about late fall. Okay, inflation affects a lot of things and we need to see those big numbers drop off. Now, if rates continue to stay as they are, how will that affect the Dallas housing market? Well, according to Knock.com, Dallas is poised to become one of the biggest buyer's markets in the country by late summer. We talk about that extensively in this video, which you may want to watch next. In the meantime, Wendy out.